Hello everyone, welcome back to another video. Today we will be talking about joint ventures and strategic alliances. And this is an important strategic alternative for all types of businesses, whether they're very small or very large and publicly traded. And although I'm going to be referencing some statistics in the presentation that focus on the larger companies and really their performance using joint ventures and strategic alliances, the lessons I'm going to communicate in this video are applicable to all sizes of businesses, from small to big. And it's very important. And the thinking behind these partnerships, depending on their involvement, is leveraging the comparative advantage of your partner in order to achieve a shared outcome. So whether it's a joint venture or strategic alliance, me as a small business, I recognize that one of my competitors or someone in another industry can really help me achieve a new market, achieve better distribution systems, whatever it is that I need to do. And so I approach that individual and I ask them, hey, can you help me? And so we divvy up the profits based on, again, the shared responsibilities of those individuals. But at the end of the day, you're accelerating your growth. And the thinking is, yes, you're relinquishing control and some profits. But if you have a smaller percentage of a bigger pie, it's much better than a larger percentage of a smaller pie. And so that's really the strategic thinking behind joint ventures and strategic alliances. So let's talk about joint ventures first. In a joint venture, two or more companies combine certain assets and work towards jointly achieving a business objective. Usually, the time period of this combination is defined and limited in duration, so it's not indefinite such as M&A. So the companies involved in a joint venture maintain their own separate business operations and continue to exist apart as they did before the joint venture. This venture is then formally created as a business entity, such as a separate corporation or partnership. A formal agreement among the venture participants sets forth the extent to which each will exercise control over the venture's activities and profits. And essentially, a company similarly names this joint venture. So if it's company ABC, the joint venture is ABC International, Inc., right? And so essentially, they put some of their assets that they need in order to achieve that goal, and they combine it with the assets and resources of their joint venture partner, and that's a separate entity. Although ownership of that entity still relies with the business, therefore, the performance of that joint venture is still reported on the financial statements of the two partners. It's just that, again, it's an operating interest rather than a full business line that they own 100% of, okay? So, how are joint ventures used? Well, joint ventures can be used for a variety of purposes, but the core purpose is to leverage the comparative advantage of each company to improve overall profitability and move towards a common goal. And some common goals may be it offers a medium in which two companies can work together, test their culture compatibility in order to determine whether a potential merger could emerge. And this is very, very important because a lot of the successful value-creating M&A that has come in the past has come where two companies that have operated in the same industry for a long period of time, they are very familiar with each other, have worked together through joint ventures or strategic alliances, and eventually decide to merge, and they're like, hey, we know each other's cultures, we know that we can work together, therefore our merger is more likely to be successful, and that's what happens. It can also enhance overall R&D capabilities, gain access to key supplies or foreign markets, and enhance distribution systems. So let's talk about each of these. So enhancing overall R&D capabilities. So a company such as a pharmaceutical company may enter into a joint venture with another business that has some specific capability that it needs to further its R&D process. In addition, if a more junior company needs funding to complete a R&D project but is reluctant to source public financing, a joint venture with a larger company could provide a unique alternative to source financing. And this is very common in the pharmaceutical industry for smaller companies that are in the early stages of development, or for in the commodity sector where you have a junior company that owns lands rights. So they don't actually own a mine, but the rights to a certain plot of land. They've conducted some geological tests and realized that, hey, there is ore in this ground that can be mined, but we don't have the management experience to understand how to really build a mine, and at the same time we don't have the name to go to the market and source that funding. So what you do is you partner with a much larger international company, a multinational company. You relinquish some of your ownership in that for that land, but you receive the support needed and the financing needed to develop that land in order to really set up a mind and become profitable. And so that's what happens with a lot of junior companies. Now, gaining access to key supplies. 2 or more companies may form a joint venture so they can have a better source of supplies for the production process. Such supplies could range from joint exploration for oil by petroleum companies to joint training programs for workers. Now, an example to really explain the benefit is if Company A owns the necessary equipment that Company B needs in order to complete the drilling of a certain oil sands region, a joint venture would be effective. You would set that joint venture up where ownership rights for that respective land or the right to drill on that respective land is given by Company B to the entity, and Company A transfers some of its equipment, whether it's the excavators or the trucks or whatever they need. They transfer some of the ownership or they lease those equipment to that entity, and therefore that entity operates and does the tasks that Company B wants to achieve while Company A receives some of the profit. Now, a very good example, and I'll talk about enhancing distribution systems, is Starbucks. So with distribution systems, say for example, you want to enter a new market and you don't have the distribution system established, right? You can acquire a company, which can be very, very expensive, especially if you realize that this is not the right market and eventually have to pull out and sell that company. So the better way to go about is to set up an alliance or strategic venture in which you as a company such as Starbucks would give up the rights to your brand and you transfer the distribution rights for that brand in that respective region to the joint venture, and then the other partner in that joint venture would be the franchisee owners or someone very, very influential and recognized in that respective market who has a local understanding of how to really develop the stores or the distribution system needed. And so with Starbucks, so consider Starbucks International. When the company enters a new market, as it did with China in the late 1990s, instead of building and operating the stores themselves, the company established joint ventures with franchisee owners in the country. And so a statement which really summarizes the relationship between them and the franchisee's owners is this one. So how we choose partners is critical to the success we enjoy. You could say we're kind of picky. We like to delve deep into another company's soul. Shared values, strategic fit, good leadership, and a strong track record are among the most important qualities we look for. And so for Starbucks, they've been very, very successful. And the reason why is because they have this emphasis. And so this statement not only explains to you how distribution systems can help a company like Starbucks, but at the same time, the reason why they've been so successful. And the reason why is that Starbucks emphasizes you need to really have a similar thinking, because at the end of the day, as the definition really describes it, you're working towards a common goal with a joint venture. You're trying to achieve the same thing. So if there's differing perspectives or differing opinions on different topics within that, overall service offering or product offering, then conflict can arise. And that's why Starbucks has been so successful. They've really sought out the right joint venture partners, and that's why they've been able to have a world-class distribution system through joint ventures. So let's talk about shareholder wealth effects on joint ventures. So McConnell and Nantel did a study of 136 joint ventures involving 210 U.S. companies over the period of 1972 to 1979. And I'll say that it's a little out of date, but unfortunately we don't have much more recent data. So the study was an announcement period, short-term oriented study that compares with many of the event studies that have been conducted for M&A announcements. And so essentially what that means is that this study looked at how shareholders reacted once an announcement was put out that this company established a joint venture with whatever partner they had. So the study showed that shareholders in companies entering joint ventures enjoyed announcement period returns of 0.73%. They also found that gains were fairly evenly distributed across venture participants. So there was a slight improvement in the share price. And so that's relative to the day before when the market was not able to price in the value of joint ventures. So essentially it means that it's not destroying value, but it's incrementally creating value for the company. Now, the study supports the idea that when considering the shareholder value wealth effects, joint ventures are a viable alternative to a merger or an acquisition. One thing that a joint venture will not provide, and for acquirers that is a good thing, is a large buyout premium for target shareholders. Without that premium, the opportunities for management to make bad decisions by overpaying may be much more limited. They may still be able to negotiate poor terms for their own companies, but the opportunities for large financial losses may be more limited, and this is very, very beneficial. So it's a great way to really test out different strategies before really committing to buying those assets. Now, what about the shareholder wealth effects for the type of joint venture? So Johnson and Houston analyzed a sample of 191 joint ventures over the period of 1991 to 1995, a little more updated. Now, they divided their sample into vertical joint ventures, which made up 55% of the study, and horizontal joint ventures, which made up 45%. They defined vertical joint ventures as transactions between buyers and suppliers, and horizontal joint ventures as transactions between companies that are in the same general line of business. The results showed average positive gains from joint ventures equal to 1.67%. So this is a more updated number relative to the earlier study, which showed a positive overall return of 0.73. So this shows that, yes, the value is created overall among both vertical and horizontal. For horizontal joint ventures, it appears that the gains are shared by the venture participants. The average returns for vertical joint ventures are somewhat higher at 2.67%. So gains are shared for venture participants, and it seems that for vertical joint ventures, there's a clearly significant positive gain of 2.7% for shareholders. Now, when they looked at the vertical sample, the gains did not accrue to both parties. So although this premium is shared among participants, the much higher premium of 2.67% was actually not shared by both parties. Suppliers gained an average of 5%, with 70% of the returns being positive, while buyers received an average return of only 0.32%, which was not statistically significant, and of which only 53% of the returns were even positive. So for vertical joint ventures, the biggest winners were suppliers, who were able to capture the bulk of the gains, while the market did not see major benefits for buyers. So this makes both logical sense and is very, very important. So with joint ventures, a vertical joint venture creates clear value and much larger value for the suppliers. So going back to that example with Starbucks, they are the supplier in that example because they're supplying their brand, they're supplying the products, the coffee beans, and all of the supplies that are needed, whereas the buyers, or essentially the distributors of those products, are the franchisee owners in China or in international markets. And so it clearly shows, and this supports the statement, that the suppliers in vertical joint ventures are the clear winners. And so this is very, very important. Now, what about restructuring in joint ventures? So this is an opportunity for companies who are interested in selling entities. So if it's a conglomerate or a business with many, many divisions, joint ventures can be used as a way to exit a business. So consider a company that wants to divest itself of a division, but is having difficulty finding a suitable buyer for 100% of the company that would provide a sufficient value to make the company sell off the division. One alternative would be to sell off part of the company, in effect, run the division as a jointly owned entity. So it's kind of an equity carve-out. So if the goal of the company doing the partial sale is really to be able to do a 100% sale, it may negotiate terms with the partial buyer, whereby that buyer would be able to purchase the remaining shares in the division at some point in the future based on the occurrence of certain events. So really it's an equity carve-out, but it can be structured as a joint venture where you move that asset into the joint venture, and if your joint venture partner is only able to buy 40% of that asset, well, they own 40% of the profits in that joint venture, and over time, as those profits really go down to that partner, they build up their cash position and are able to really fully buy out that asset. Now, what about some potential problems? Now, the potential problems with joint ventures are as varied as the type of ventures. They may fail for many, many reasons, but here are some examples. So the number one, of course, and this is the same for M&A, the partners do not work well together. The personalities don't mesh. There are disagreements between the participants due to conflicting venture goals, which were not established at the beginning. That's why Starbucks emphasizes on having those shared values, on having those shared goals. It may require the sharing of intellectual property, which one participant may not be willing to share because they're afraid, they're going to steal our IP, and therefore we've lost our competitive advantage, and therefore they're not as involved in the joint venture, and therefore it will fall apart. One partner ignores the hold-up hazards of the other, and therefore they're not fully committed. So hold-up hazards are essentially the investment made in order to really start that joint venture. So say, for example, you have a distribution system joint venture where you have a supplier and the distributor. Now, if the distributor needs to make an investment in order to really modernize their distribution system in order for that supplier to really take advantage of that distribution system, that initial investment is not covered in the joint venture. The supplier has to do, the distributor has to put up that investment initially in order to just enter the joint venture. And if the supplier does not respect that investment and therefore relinquish a little bit more control and a little bit more profit to compensate for that investment, then usually the joint venture does fall apart in the early negotiation stages. In addition, some joint ventures just fail to accomplish what they set out to do, and thankfully enough, because it has a set life, after you exit that joint venture, you don't have to stay in that unprofitable business or stream. Now let's talk about strategic alliances. So strategic alliances are less formal associations between companies compared with joint ventures. In a joint venture, a separate entity is often created, whereas in a strategic alliance, the agreement and the relationship are less formal. So that's the big difference between the two. And surprisingly enough, you'll see a lot of incorrect information online talking about how partnerships, simply sharing brands, are considered joint ventures. The sharing of brand names are considered strategic alliances because you're not transferring ownership of that brand into a separate entity. You still own that brand with your own company. You're just partnering, you're setting up an alliance in order to co-create or co-represent one certain product. Now, enhancing R&D is a major reason why companies form strategic alliances. So Robinson reports a National Science Foundation study that indicated that 1 company in 10, so 1 out of 10 companies that was involved in R&D financed such work outside of the company, either through joint ventures or strategic alliances. Now, the governance of strategic alliances is really the big thing because here you're not setting up a separate entity. Instead, you're really signing a contract and stating and making the commitment that I'm going to do X. And that's much harder to enforce. So when a company acquires another company, the governance process is really set in there in the sense that the acquirer pays for and receives the right to control the target. The governance of strategic alliances is bilateral and is determined by the agreement the alliance partners enters to, as well as by factors such as the non-legal commitment of the alliance partners to make the alliance succeed. So when you acquire a company, it doesn't matter how the people of that acquired company feel, you own them technically, which is not, it's very, very bad to say that because then that creates further conflict. But essentially, yes, you paid a significant premium to acquire the right to really tell them what to do. But with strategic alliances, you only have a contractual agreement. And majority of the time, as long as you meet what's on the paper, technically you're following the contract. But if people are not fully invested in that strategic alliance, most of the time it won't work, and that's why the success rate with strategic alliances, and therefore the things that are less involved, are significantly lower. So if the success of the strategic alliance requires that you share confidential information, then the parties must be confident that this valuable intellectual property will not be used inappropriately. Now, what are the shareholder wealth effects of strategic alliances? So one study looked at the shareholder wealth effects of 345 strategic alliances over the period of 1983 to 1992. Almost 1/2 of their sample involved alliances for marketing and distribution purposes. So for the overall group, they found positive abnormal returns equal to 0.64%, very, very similar to the same study conducted for joint ventures. So the study also found no evidence of significant transfers of wealth between alliance partners. This implies that there was no evidence that one partner was gaining at the expense of the other. And this is very good because usually when you talk about strategic alliances, you have a very, very big company taking advantage of the niche expertise of a smaller company, or a smaller company trying to take advantage of the distribution system of a larger company. At the end of the day, both share. In relative terms, in percentage terms, it's clear. But of course, in dollar terms, if it's a larger company, then really the amount of dollars will be much lower relative to their overall earnings potential compared to the smaller company, which can gain much more in percentage terms because they're smaller. Now, looking at the type of strategic alliance, so the shareholder wealth effects for the type, the same study also looked at how the shareholder wealth effects varied by the type of alliance. They separated their sample into horizontal and non-horizontal alliances, so essentially vertical alliances. They found that horizontal alliances that involved the transfer of technology provided the highest cumulative abnormal return of 3.54%. Now, this may help explain why strategic alliances occur so often between technologically oriented companies. Non-horizontal alliances that were done to enter a new market provided a positive but lower return of 1.45%. Now, both of these returns are great. They're not insignificant. They're a clear positive return. But it seems that based on this study, horizontal alliances are much more successful. And it's interesting because if vertical joint ventures are more successful than horizontal joint ventures, then why are horizontal alliances more successful than vertical alliances? Well, maybe it's that level of involvement. With higher involvement and therefore setting up a separate entity rather than a contractual agreement, people are more committed, and therefore you'll see that suppliers can take advantage of the distributors who are going to be distributing their product or the buyers of their product, right? So that's why joint ventures work, vertical joint ventures work. With horizontal alliances, because both of them specialize in one respective area, maybe they're not as committed, but because of their specialization, they can increase the amount of knowledge and buying power and market power that they have to therefore increase their returns. So that's really my thinking when I was reading this. Now, another study showed that the abnormal returns were negatively correlated with both the size of the alliance partners and their profitability. Big statement right here. We see that the market is concluding that larger and more profitable partners will capture fewer of the gains from the alliance. This does not imply that the partnerships are not also good for larger companies. Given that they are bigger and their profits are greater, the relative impact is much smaller. For younger businesses, however, the strategic alliance offers an interesting alternative. So as I said before, in relative terms, the dollar impact for larger companies working with smaller companies through strategic alliances is much lower. However, at the same time, you'll see that that level of involvement is much lower as well, and therefore the profitability of that alliance is not as high. So if smaller companies partner with medium-sized companies or larger, smaller companies, so not as long the bigger in size your alliance partner is, the less they're going to care about you as a smaller company, and therefore the profitability of your alliance is much less. So it makes rational sense based on statistics and based on the studies that are available over here that working with maybe a medium-sized company where they may not benefit the same amount but still benefit, there is a clear value from the strategic alliance, there's more profitable areas of opportunity for the smaller strategic alliance partner. So hopefully you're able to get that. So now, what determines the success of strategic alliances? This is another big question. So which types of alliances are more likely to be successful and which will be more difficult to pull off? Well, a study analyzed a sample of 78 companies that reported on 1,572 alliances that have been established for at least 2 years. So this is a big sample group. Now, they found that firms that had more experience with alliances were more likely to be successful in future alliances, which makes sense. Also, companies that had a dedicated alliance function, such as a department and department head dedicated to overseeing alliances that the company entered to, were more likely to be successful with their alliances. And so the success rate was 68% relative to a 50% success rate. So that's an 18% increase in the success rate, a clear advantage. So the big takeaway from this slide is that if you are a small business, you don't have a lot of people. And sometimes you might lack the management capabilities to manage a strategic alliance. But it's important. It is very important to focus on that alliance in order for it to be successful. Because if you just leave it to one side and hope that the people meet their contractual obligations, the success rate is not as high, and therefore you might not be as profitable. So as long as you dedicate one person, or maybe a group of people if you have the opportunity to, the success of your alliances will be much more profitable and much higher. So just the final slide in this presentation, I wanted to really compare the level of commitment across the different partnerships. So strategic alliances feature less involvement between the alliance partners than joint ventures, which in turn are also a lesser commitment than a merger or acquisition. The question is whether the objectives of an acquisition can be achieved more cheaply through a joint venture or strategic alliance. So looking at this illustration, as you move to the right, commitment increases. So from strategic alliances, you move to joint ventures where you actually set up a separate entity, and to M&A where the two companies actually become one company now. So the level of commitment increases. Also, as you head to the right, the cost of integration, the cost of reversing that decision become much higher. So the risk increases as you head towards that same direction. So it's important when you are considering the strategic alternatives for your business to ask yourself, do I really need to buy this company in order to achieve what I want? Can I set up a JV? And really, you try also not to set up a JV if you could. Maybe all you need is if you want to co-collaborate on one respective product, don't set up a 5-year joint venture, set up a strategic alliance with the specific function of co-creating this product for X amount of months for how long you want to sell that product for. So this is the thinking for business owners. You want to ask yourself, what am I giving up? Because you are giving up things. With M&A, you get control, but at the same time, there's higher risk and higher cost. With strategic alliances, there's less risk, but at the same time, not as high of a level of commitment, and therefore maybe not as successful. So if it's a very technical in nature, if it's something that involves a lot of commitment, then strategic alliances are probably not your option. So that's essentially it. Other than that, if you have any other questions, please do comment below and I'll be sure to get back to you as soon as possible. And if you like the video, please like and subscribe to the channel. I appreciate all the support that you guys can provide for me as I continue to build the channel and really help people learn more about business and different advisory topics. So have a great day, guys. Thank you.